Hello everyone, welcome back to another episode of the Investment Hound podcast. Before we get into today's episode, if you have not already grabbed yourself a copy of Grandad's new book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience, make sure you go and get it today. The links will be down in the description below. And if you want to know what it looks like, take a look over Grandad's head there and you'll see 3 red books. I designed them, by the way. So make sure you go and grab yourself a copy. If you're in Europe, you can get it on amazon.co.uk. And if you're outside of Europe, you can get it on amazon.com. One more thing before we get started on today's episode, make sure you go follow us on Instagram and TikTok at The Investment Hound. Now, one more thing actually before we get started in today's episode, Grandad. So we started working on the promotion of this book about this time last year, wasn't it?
On the podcast or just promoting?
In general?
I think so. It certainly was somewhere between October and March last.
And just for the listeners at home, Grandad, right? When we started working on this book, I didn't really have a lot of knowledge on investing in the stock market or how the markets moved or how it worked or anything like that. But when we agreed to start this podcast series, okay, I was like, Jesus, I need to actually, start learning this. And
don't tell me you got the exams.
I did, Grandad. I was getting to it. I was doing a nice big long story. Anyways, fast forward until maybe about June, I decided that I actually really, really, really like doing this. And I really like learning about this. And and in Ireland, okay, in order to be able to advise people on investments or pensions or insurance or loans or mortgages or anything like that, you need to do a thing called the QFA to become a qualified financial advisor, which is where you sit 6 exams. And in July, I took up the first 2 exams, loans and regulations, and I got my results from loans and regulations in this morning about 30 minutes ago, and I passed them both. Thank God. So now I'm 1/3 of the way there.
You inherited my brains.
Yeah. If only I got the looks as well, Grandad,
Oh, jeez.
Yeah. So I just thought that would be some interesting news for the listeners at home is that, this is genuinely a passion and an interest of mine and Grandad's, and hopefully you guys feed off that as well, and it encourages you to go out and do your own learning and research.
Tell them to put the check in the post for the party. The celebration party.
Yeah, you can all send me in $6.70 for a pint of Heineken if you don't mind. Okay, so let's get started in today's podcast. So anyone who's been keeping up to date with our podcast series know that Grandad and I, over the last few episodes, bar the last one where we had done an episode on the budget for 2025. So if you haven't checked that out, make sure you go watch it. But before that, Grandad and I have been building our own stock portfolio based on all the information Grandad has taught us and also the information from his book. So we're going to continue on with that there today. But before we do that, let's have a look at the previous shares that we have analyzed and added to our portfolio. So the first one is Whitehaven Coal Limited, who are a mining coal company. The second, CVS Health Corporation, who are a healthcare and retail pharmacy. Third is Volkswagen, who are a German automotive company. Adecco, who are a human resources and staffing company. Banco Santander, financial services. Total Energies, who are energy, who do oil, gas, and renewables. Sunoco LP, who are an American energy fuel distribution company. Ryanair, the Irish low-cost aviation company. And the last 2 we did were National Australia Bank, who are a financial services bank in Australia. And then Bristol Myers Squibb.
That is a pharmaceutical company in the United States, but worldwide.
Yeah. So if you haven't watched those episodes, go check them out because we are going to continue on from that there today. So the other day, Grandad sent me over 2 more shares to analyze and make a decision on. So the first one is a company called EDP Energias de Portugal, commonly known as EDP. They are a multinational utility company with their headquarters in Lisbon, Portugal. It is one of the largest energy producers in Europe, specializing in the generation, distribution, and sale of electricity and gas. EDP has a strong focus on renewable energy, particularly wind and hydroelectric power, and operates through its subsidiary EDP Renovarias, or however you pronounce that, which is the world's leading renewable energy company. EDP is committed to sustainability and has been transitioning its energy portfolio towards cleaner sources as part of its strategy to reduce carbon emissions. The ethics bell is going off in Grandad's head here. EDP operates in various countries across Europe, America, and Africa, and has become a key player in the global push towards renewable energies. So EDP's primary listing is on the Euronext Lisbon. The sector is utilities and specifically electricity. Because of that, their sector type is defensive. So just a little quick recap on what a defensive sector is. These tend to remain stable or perform relatively well during economic downturns because they provide essential services or products that people need regardless of the economic condition. Their market cap is 16.24 billion, so they're a decent sized company in Europe. The price is €3.89 as of yesterday, I believe. The dividend yield is 5%. And this quick, 17 of the analysts predict an increase of 42.5% of the current dividend for next year, which would bring it up to 20 cents a share. So the dividend.
No, it wouldn't. Oh, sorry, no. What would it bring the yield up to?
Yeah, per share, yeah.
No, what would it bring the yield up to?
20 cents
a share. Yield
is
5%, correct?
Oh, sorry.
So 40% of 5% is 2%. So it brings the yield up to 7%.
Which is nice. So the dividend per share growth for EDP is in line with the industry average relative to its peers, and the earnings per share growth is the highest in its industry. And they've also had a steady dividend yield increase since 2020. Next, their dividend payout ratio is 64%. The PE ratio is 12.3 times, and their beta is about 1.03 times as well. One new kind of statistic or ratio I want to bring in here is the debt to total capital ratio or percentage, which is 57%. And the reason why is that I want to bring that in because it's significantly lower than the previous years of 171%. From the analyst rating, they're rating it, majority say buy. From Trading 212, from Trading View, they're rating it a strong buy to buy, and on Financial Times, they're rating it an outperform to buy. And for anyone listening at home, outperform means that the company will produce a better rate of return than similar companies, but the stock may not be the best performer within its index. The analysts are for the 12-month price forecast. The lows are only down 2.5%, down to 380. The mediums will bring it is about 23%, are bringing it up to 480, and the highs 74% are bringing it up to 680, which is very good. Revenue sources, 50% of its revenue come from Portugal, and then the next biggest one is Brazil and then Spain, and then also a tiny bit in the US and other regions as well. Some recent news on EDP. So Barclays named EDP as one of its top picks for integrated utilities, and integrated utilities are companies that operate across multiple segments of the energy supply chain, often providing a range of services from energy generation, transmission, distribution, and sometimes even retail services to consumers. And also the CEO notes increased demand for renewable energies due to AI and data centers, where approximately 80% of its revenue comes from renewable energies. So, what's my conclusion on EDP? Yesterday, I went off and I bought 12.5 shares for €50 of EDP because I liked it so much. What about you, Grandad?
Well, I just want to pick up on one of your metrics.
Okay.
According to me, the payout ratio is around the 55% mark. It's not up at 60-something percent. 60-something percent is a bit of a worry. 55% is probably doable.
Okay.
So I would rate it a strong buy. That's why I gave it to you. The other thing that you possibly didn't say that you should have is the share has fallen sharply in the last month.
Oh, right.
So you're actually buying it at a low, which is a very nice way to buy shares. And so therefore, I would say that it's trading below its moving average. It's a sweet buy. The one thing you don't include in your metrics that I would is the PE ratio. I don't think you mentioned that, did you?
I did mention that, yeah. So the PE ratio is about 12.
12. And that's perfect. 10 to 12, remember I was saying to you, is acceptable. It's suggesting it's slightly on the cheap side. So it's a cheap buy, a good buy. And I'm glad you bought it. And good luck with it.
Thank you. Well, one of the reasons, as we briefly discussed yesterday, Grandad, when you were over here, one of the reasons why I was attracted to this share was because recently I've been doing a bit of moving around with my stock portfolio. So currently the only shares that I hold are the S&P 500, Volkswagen, Bristol Myers Squibb, and now EDP. And the reason why I wanted to buy them was because I want to move away from the American markets. So what I did was I sold all the profit I made on my S&P, which is it's only like 190 quid, 170 quid, something like that. And I sold it, leaving only the invested sum in the S&P. And I want to then use that profit to go off and diversify the portfolio into Europe or into, the
in other words, you took
eastern
the profit,
side of the world.
You took the profit that you'd earned on the S&P and you took it back and you're putting it into different shares outside of the US.
Yeah.
But you still have left the original holding of that you had invested in the S&P stand. That's a classic move and a good move, I suspect.
And my reasoning for wanting to do that is because I think that with the upcoming election in 2.5 weeks or 3.5 weeks or whatever it is, I think it's going to cause a lot of disruptions into the S&P. And when I had sold the S&P, it was at an all-time high. So I was like, okay, at least I'm not, missing out on anything. But I think it's going to cause a bit of disruption into the market, regardless of who gets the presidency. And I just thought now would be a good time to do that, So.
Well, I have a phrase in the book which encapsulates your thought process, which is that you never lose money making a profit. And that's what you've done. You've made your profit, you've landed the fish, and off you've gone, right?
Yeah.
You don't lose money doing that. Okay, you might have made more profit next week, but you might have made less profit next week. Be thankful for what the Lord has provided.
And the share that I bought before EDP was Bristol Myers Squibb. And maybe some people out there are thinking, well, if you want to move away from the American market, how come you bought Bristol Myers Squibb? And the reason for that is because of its sector being pharmaceuticals, which means it has an exceptionally low beta. So it doesn't move within the current economic cycle.
Defensive. It's defensive.
Yeah.
So you have two defensive stocks.
And I quite like that because I think and I remember you putting this in the book, Grandad, it's a bad idea to buy cyclical shares, or not necessarily cyclical shares, but shares that require people to have money, like jewelry companies, luxury brands. It's a bad idea to buy them at the peak of the market,
Yeah.
So I was like, okay, maybe defensives are a good time. So if you can find undervalued or underpriced defensive companies, that would be good.
And the other thing is, the portfolio that we're talking about here will have cyclical and defensive stocks. So part of the diversification process is to have yin and yang.
Yeah, that's true. So what's your experience been like with EDP, Grandad?
Well, I bought it reasonably. I had bought it some years ago. I think it's in the book, actually, right? And I made money out of it. And I decided, well, it's done well after that. I now land the fish. And I landed the fish. But recently, I suppose in the last 3 months, I bought EDP again.
Oh, okay.
And I have about $5,000 in EDP. And I'm looking forward to next year. I think I'll make money on it. And I think if I can get a 7% dividend, I won't see much reason to to sell it.
Yeah. Yeah.
And it's a nice defensive stock, and it gives you access to the Portuguese market, which is a different market to some of the other markets in Europe.
Yeah. One piece of information that I saw when I was researching this company as well is that utility companies, not all of them pay dividends. And the ones that do pay dividends as well, 5% is from what I saw, particularly high for a utilities company.
Well, 5% is a lovely dividend yield, and 7% is an exciting dividend yield, and that's what drives me, the dividends, as you know. Okay, and getting 5% with a possibility of getting 7% is a very nice feeling.
Well, that's good. That's good that we're both on the same page for this one. The next one, we might have a different view. I'm not sure. So the next company that we're going to be looking at is a company called Verizon Communications Incorporated, who are one of the largest telecommunications companies in the US, providing a wide range of services, including wireless communications, broadband internet, and digital television. The company operates primarily through its wireless segment, which is the largest revenue generator, serving millions of customers with mobile services across its vast network. Verizon is known for its high-quality, reliable network and has been a leader in the rollout of 5G technology. In addition to its consumer services, Verizon offers enterprise solutions, including cloud computing, security, and Internet of Things connectivity. The company is also known for its strong dividend, making it a popular choice among dividend investors. So, Verizon, their primary listing is on the New York Stock Exchange. Their sector is telecommunications. The service or the sector type is defensive. Now, when I was actually analyzing or first looked at this, I would have instinctively thought that this was a cyclical share, as people or consumers that use electricity, you know what I mean? The link I made in my head was that customer cyclical, but this is actually highly defensive because people need internet connection, TV, broadband, blah, 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 during economic booms and economic downturns.
That's right. I assumed when I went into telecom shares first time that in fact, I don't actually have to have a mobile or a cell phone, as they call it in the States, right? And therefore, it's cyclical. But in fact, the horror that is in people's faces if they temporarily mislay their mobile phone has to be seen to be believed. Yeah. And in fact, nobody can live nowadays without a phone in their pocket.
Yeah.
So I agree. I think it has moved from being a cyclical stock to a utility.
I think as well, Grandad, that also shows the difference in generation as well, that you would think that this would be a defensive because you could live without your mobile phone. But no, you're dead right. Definitely nowadays, it's basically impossible to live without internet communication. So moving on then, the market cap is $182.5 billion US dollars. Their price is $43.36. Their dividend yield is 6.14%. And 21 of the analysts predict an increase of 2.1% for the next year, which would increase the dividend yield per share of $2.68. The dividend per share and earnings per share growth rank
2% of 6%, right?
Yeah.
10% of 6% is 0.6. 1% is 0.06. So 2% is 0.1. So your what's your dividend yield at the moment? Something like 6.
About 6.14.
Yeah, well, it'll probably go to 6.24, maybe 6.3 next year. So it's a modest increase in the dividend, but there's nothing wrong with 6%.
It's true. However, there might be something wrong with the dividend payout ratio, which is at 99%.
Well, I didn't quite get 99, but it is high.
Well, we'll move on and we'll come back to it. The PE ratio is 16.5 times. Their beta, I got pretty different figures here for the beta, okay? Financial Times were telling me their beta is 0.16, and TradingView were telling me their beta is 0.4. So we can say, let's say 0.3 for the beta. And then this is also...
The thing about that can be, it depends on whether somebody's looking at last year, or somebody's looking at this year to date, or somebody's looking at the last quarter, So that's why you get those different kind of metrics.
Okay. Their debt to total capital, and I wanted to include this for a reason as well, is 60% and is significantly down from the last year's of 144%. The analysts rated, I found on average it was a hold. majority holds, some buys, some strong buys, and maybe one sell, and also got some holds and outperforms. So it's kind of leaning towards the buy/hold rating. The price forecast, the highs, 27% said that it could go up to $56. The mids, about 6% said it would go to $46.50, and the lows, about 16%, said it would go down to $37. From the revenue sources, 100% of the revenue is generated within the US, and then some big news as well that recently, over the past couple of years, they acquired a new company, a competing company called Frontier, who went bankrupt due to unsustainable debt. Something else here I wanted to include is the dividend per share and earnings per share growth ranked below the industry average relative to its peers. Okay, I just forgot to mention that when we were talking about the dividends. So, Grandad, the conclusion to this one for me is, as I'm sure you've already guessed, is I wouldn't buy it. I would probably stick it on the watch list. It would be one I think that would be interesting in the future, but the current payout ratio for me is very worrying. I know you said you got a different figure, actually. What figure did you get?
58%.
Wow, that's significantly different.
Yeah, but it's still higher than the 50. So, it is at the upper end of what's acceptable to me. It's at the upper end of what's unacceptable for you. But I think 58% is what I got. And I read an article where they were saying it kind of, it's around that normally, Now, you can always have a 1 year where, the payout ratio goes crazy. But if that's due to exceptional items that you're not going to have going forward and that you didn't have prior to that, you can ignore it. So my feeling would be that the 58% is probably where they are. Okay. And therefore the dividend yield, and by the way, the analysts are saying the dividend yield is going to rise, so even though modestly. So my view would be that the payout ratio, I'd live with that. I'd accept that as kind of outside my norms. At 58, I wouldn't accept it at 99. But unless it was an exceptional item that caused it.
I'm looking at it here on Financial Times, Grandad, okay, and it's saying that dividend yield, 5-year average growth, 5%. Dividend yield for 5 years is about 5% on average. The dividend growth rate is about 2%, but the payout ratio for the past 12 months is 99.5%.
Yeah, but what I'm saying to you is going forward, I think they're saying 58.
Oh, okay. That's less worrying then.
Yeah.
Okay.
So do you want me to tell you what I think?
Sure.
It's absolutely certain that it's not as attractive a share as EDP. However, from my perspective, it is an attractive share at the price it's at now. See, the prices have come down at the price it's at now, and the dividend is attractive, and it looks like it's sustainable. Okay. So, but however, my experience, I've got Verizon. I think I have Verizon for about 5 or 6 years, and the share price has gone nowhere. Okay. It's a very difficult world to be in, the telecommunications world, because as you said there, they have a digital TV. In other words, they're moving into broader and broader offerings. Some of them are like Disney World, for example. Some of them are putting in their own content into those TVs, right? So it's undergoing, if you like, a strategic transformation, and that makes it a riskier share than if it was, like a pharma company, fairly consistently normal, Yet, I haven't lost an awful lot of money. I've lost about 5 or 10% on the share, I think, in about 10 years, right? But the dividend is reasonably good. Would I buy it now? I certainly would hold it. I have no intention of selling it. Buying it is a harder decision. Yeah. So we're not too different on this one.
Yeah, I had in my notes there that
we'll buy it and see how it goes to see what happens.
Yeah. I had in my notes there that I think it could go either way, similar to what you just said there. I think it might do well or it might not do well. But for me personally, that's too risky. So that's why I wouldn't personally buy it with my own portfolio.
No. But in building up a portfolio, it's good to have ones that are risky in there as well, to see what happens to those and to see if our understanding of risk is right or wrong.
Yeah. Granted, is there such thing as a forward dividend payout ratio?
Well, there is, but the problem with that is that depends on what the guy thinks the profit is going to be next year. So it's only as good as what the guy thinks the profit's going to be. But you see, if you have a situation where you have a company that has, for example, let's say you buy a business and, you pay, say, 2 billion for the business, okay? And now you're being a big company, we see 100 billion company, and you buy a business for 2 billion. And you're going along and you suddenly discover that it's supposed to be making you X amount each year in profit. And it's making you X minus Y each year in profit. So you decide to write down some of the value of the investment, okay? So that hits your profits. It increases your payout ratio because you've less profit and you're paying the same dividends, right? But next year, that will all normalize back again. So, it does seem to me that if the analysts are saying that the dividend is going to go up by its normal 2 or 3% a year, which is the kind of the inflation rate, okay, then they're not worried that because the dividend payout ratio is 99%, the dividend is unsustainable. They're comfortable to assume that there'll be roughly the same dividend or a little bit more next year. So that's why I would hold it. It's certainly it's a strong hold, and it's a weak buy, if you know what I mean. But we'll put it in and watch it in the portfolio because it's not costing us anything to put it in and watch it in the portfolio.
Okay, well that's interesting that we somewhat agree on that one.
Yes.
It was definitely one of the more challenging ones when I was analysing it.
And I gave it to you on that basis because, for example, I have a metric and the EDP rate it's the lower the figure, the more attractive the company is to me. The EDP metric is 24 and the Verizon metric is 30. And the EDP metric is the 5th most attractive share in the watch list I have, my watch list, okay? But Verizon is the 6th most attractive, right? So that's why I gave you the two of them on the basis that they were the most attractive. But one was a clear winner and the other was iffy.
Yeah. Just for a bit of context for the listeners at home as well, Grandad's referring to his own personal Excel spreadsheet that he has created a bunch of different formulas and if functions and all whatever it is. So when he puts in a share, he just inserts all of the metrics that he finds when he's doing his research, and it gives him a score at the end in comparison to the other shares and stuff like that as well. And so the lower the number for him is the more attractive one.
And do you know why I gave you the 5th and 6th most attractive shares? Because you already have in the portfolio 1, 2, 3, and 4. So I gave you 5 and 6. And of course, they're going to get ropier the further out you go, unless there's a change in some of them,
Wait, do you mean in my portfolio or in the one we've built
in my
together?
portfolio?
Okay.
In my own personal portfolio. Yeah. They're the 5th and 6th. And I've already given you 1, 2, 3, and 4.
Do you know off the top of your head what they were?
I think I have it. I might be proven wrong now. Wait, let's see. Sunoco.
Oh, okay.
Adecco. That's the Swiss recruitment company. Yeah. Volkswagen. And what's 4? 4 is Total Energies.
Oh,
you have all those.
Yeah.
So then I get, and Total Energies, for example, is 22 in my metric, okay? And remember I told you the lower the better. And I said to you EDP is 24. And the next lowest is Verizon at 30. So obviously the further out you go from and the lowest is Sunoco at 16. So the further away you go from 16, the riskier the shares get.
Yeah. See, I've been debating whether or not to buy Adecco, but the only thing that, and I said this in the podcast as well, the only thing that concerns me about Adecco is that it's highly cyclical. You know?
Yeah. Yeah.
And I think if you were to get in maybe now, like it just doesn't seem like it's a good idea to be hopping into. And as well, they're trading near their all-time high as well, and it just doesn't seem like a good idea to get in. My gut is telling me not to do it, but I'm looking to diversify into Europe. So
yeah,
it's a tricky one.
Yeah, I mean, I put it this way: I wouldn't buy it now, but I'd hold it. You know.
Oh, okay.
But if it comes down, another 10%, you know, it's a very big recruitment company, you know. Yeah. It's a Swiss company too, you know, which tends to be safer than the norm, you know.
One thing I am thinking of doing in the portfolio is, because I now have just like 150 quid sitting in that trading 2 and 2 account doing nothing. So one thing I'm thinking of doing is I might double down on my investment for Volkswagen, because they're still hovering around that 95, 96 mark, and they've been hovering around it for like maybe 3 or 4 weeks now. So they might have bottomed out.
I went into Volkswagen. I bought my normal $5,000 worth, okay? Yeah. And then the share came down a bit.
Yeah.
I said, oh gosh, if it was worth buying it at the higher price, it must be worth buying it even more at the lower price. So when I go at the lower price, and I was down 25% of the whole bloody lot of the price. So just be careful, you know, that it's not a false dawn.
Yeah. Sure, I remember, Grandad, when we were discussing it on this, it was like €125 a share, and now it's €95 a share, something like that, you know.
Yeah.
You know, but
you know, but you know what they call it? A dead cat bounce, you know. That, you know, when you throw the cat out the window onto the street, you know, from the top floor, as he goes down, right, he hits the ground, and he bounces. Oh. It's on my back, I'll buy it. And then down it goes again. So just be careful of the old dead cat bounce. But nobody knows when it's a dead cat bounce and when it's a genuine recovery.
Well, they have a very high dividend that's well covered as well. So
yeah, and they're trading very modestly. Their PE ratio, which is the other key thing, the PE ratio for Volkswagen is less than 4, which means that they're expecting you know, not a big increase in profits. We're expecting the profits to be quite low next year.
Yeah, so I'll have to think about that anyway, because every Friday I invest, you know, when I get paid. So that might be the move today. I don't know. We'll see. Okay, well, I think we'll wrap it up there, Grandad. Just for the listeners listening, if you haven't already gotten yourself a copy of Grandad's new book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience, make sure you go and get it. You can access it through the link down below if you're in Europe, amazon.co.uk, and if you're in or outside of Europe, amazon.com. Also follow us on Instagram and TikTok at The Investment Hound.
Now, I want to do something to surprise you before the end of this podcast.
Okay.
Okay, listeners. Congratulate Adam on passing his exam. Good luck.
Thank you very much. Bye-bye. Bye.